3 weeks ago, a set of superannuation changes quietly took effect, and one of them is the biggest shift in how super gets paid in 30 years. Caps went up. A brand new tax started. The way your employer pays your super was rewritten entirely, and buried in that last change is a trap that could push you over a contribution cap this year without you doing anything wrong at all. Here's every number that changed, what it means for you, and the one thing almost nobody has spotted. I'm Jeff, and this is Aussie Retirement. I'm not a financial advisor, and I won't pretend to be one. What I do is read the rules so you don't have to. The ATO guidance, the Services Australia thresholds, the ASFA figures, I go through them, check them against the current numbers, and explain them in plain English, because too many good people pay a heavy price for rules nobody ever bothered to explain. Hit subscribe so you don't miss out. It also helps other Australians find this channel. 1. Payday Super has started. The super guarantee rate stays at 12%. It hit its legislated target last July, and there are no further rises scheduled. What's changed is the timing, and it's a genuine overhaul. Until 30 June, your employer could pay your super quarterly, up to 28 days after each quarter ended. That meant your money could sit in their account for 4 months. From July 1st, super must be paid on your payday, and it has to reach your fund within 7 business days. For you as an employee, there's nothing to do. Your money simply arrives sooner and starts compounding earlier, and unpaid super becomes far easier to spot. That last part matters more than it sounds. The ATO has estimated the gap between super owed and super actually received runs into billions of dollars a year, and the old quarterly system made it easy for a shortfall to go unnoticed for months. Under Payday Super, a missing contribution shows up within days. If you run a small business, this one matters a great deal. Payroll systems need updating, cash flow changes shape, late payments attract penalties and interest, and the Small Business Superannuation Clearinghouse is no longer available. Note the deadline is the date your employee's fund receives the money, not the day you send it. So build in processing time. 2. The trap nobody's talking about. Here's the transition problem. Your employer still had to pay the final quarter of last financial year under the old rules, which could land in your account as late as 28th July. On top of that, you'll now receive 12 months of payday contributions. That means some people will receive up to 15 months' worth of employer contributions inside this single financial year. If you're also salary sacrificing or you're a high earner, that overlap can push you past your concessional cap without you contributing a cent more than you planned. If you're anywhere near the cap, check your year-to-date contributions now rather than in June. 3. The maximum contribution base is now annual. Employers only have to pay super up to a certain level of earnings, called the maximum contribution base. It used to be a quarterly figure. From 1st July, it's annual, and for this year it's $270,830. The effect for high earners is front-loading. Your employer keeps paying super each payday until your qualifying earnings hit that number, then stops for the rest of the year. So your super arrives faster and earlier, and if your package is inclusive of super, your take-home pay may dip early in the year and rise later. 4. Concessional cap, $32,500. Concessional contributions, employer contributions, salary sacrifice, and personal contributions you claim a deduction for are taxed at 15% inside your fund. The annual cap on those has risen from $30,000 to $32,500. That extra $2,500 of room sounds modest, but remember what it's doing. For someone on the 30% marginal rate plus the Medicare levy, moving $2,500 from salary into super saves about 17 cents in the dollar. Small change, repeated every year, compounding for a decade. 5. Carry forward, up to $175,000. If your total super balance was under $500,000 at June 30th, you can go beyond the general cap by using unused cap amounts from the previous 5 years. Stack them all, 5 unused years, plus this year's $32,500, and the theoretical maximum is $175,000. Last year, the equivalent figure was $167,500. It applies automatically once you exceed the general cap, using the oldest unused amounts first. 2 things worth knowing. The oldest year drops off every 1st of July, so this isn't a bank that grows forever, And if you're 67 or over, you need to meet the work test before you can claim a deduction for a personal contribution. Check your available cap in MyGov through ATO online services. 6. Non-concessional cap, $130,000 or $390,000. Brought forward, non-concessional contributions are made from money you've already paid tax on. You don't get a deduction, and they aren't taxed going in. The annual cap is always 4 times the concessional cap, so it's risen to $130,000. The bring forward rule lets you compress up to 3 years into one, up to $390,000. If your total super balance was under $1.84 million at the 30th of June, between $1.84 million and $1.97 million, you get 2 years' worth. And if your balance was $2.1 million or more, you can't make non-concessional contributions at all this year. 7. Transfer balance cap, $2.1 million. This is the lifetime limit on how much you can move into a tax-free retirement income stream. It's risen from $2 million to $2.1 million. One important catch. If you start your first income stream this year, your personal cap is the full $2.1 million. But if you already started one, your increase is worked out proportionally, based on how much of your cap you'd already used. So your personal cap rises by less than the full $100,000, and possibly not at all. Your own number is in MyGov. Don't assume it's $2.1 million. 8. Government co-contribution. If you make an after-tax contribution of $1,000 and your income is under $49,293, the government adds $500, a 50% return before your money has earned anything. The benefit tapers away by 3.3 cents for every dollar you earn above that and disappears entirely at $64,293. Both thresholds rose this year, so more people qualify than last year. You don't apply. The ATO works it out when you lodge, provided your fund has your tax file number. It's one of the few genuinely free things in the system, and it's routinely ignored. Worth checking whether a spouse on lower income qualifies, even if you don't. 9. Division 296, the new tax on large balances, and the big one, Division 296, started on July 1st. On top of the usual 15%, an additional tax applies to earnings attributable to the portion of your total super balance above $3 million, bringing the effective rate on that slice to 30%, with a second tier taking the rate on the portion above $10 million to 40%. 2 clarifications because the reporting has been messy. It only ever applies to the part above the threshold, never your whole balance. And after significant public backlash, the final law does not tax unrealised gains. Bonus, the effective tax-free threshold. One more number that changed. The effective tax-free threshold, the point where you actually start paying income tax once the low income tax offset is counted, has risen to $22,866, up from $22,575, because the second tax rate dropped from 16% to 15%. If you're using contributions to reduce your taxable income, that matters. Most people aim at $18,200, which isn't the real number. I've done a full video on where you should actually stop. Link in the description. That's every change. If you take one action from this video, make it this. Log into MyGov, open ATO online services and check 3 things. Your year-to-date concessional contributions, your remaining carry-forward cap, and your personal transfer balance cap. All 3 moved this month, and all 3 are specific to you rather than to the headlines. Everything in this video is general information, not personal advice. Your own circumstances deserve a proper look from a licensed financial advisor, a registered tax agent, or the free financial information service before you make any decisions. If you found this useful, give it a thumbs up and hit subscribe. I'm Jeff. Thanks for watching, and whatever you take from today, take it to someone licensed before you act on it.